I'm joined now by Craig Dade, Senior Technical Services Manager for Colonial First State. Good on you, Craig.
Andrew?
Now look, you're about to do your presentation.
Yes.
Risky business.
Yes.
You wearing pants or not?
Absolutely.
You are
Pants
going to
on
wear
all the way through.
You're going to at least wear some Wayfarers at the beginning of it? You're going to...
I should, shouldn't I?
Right.
No. It's all about risk. The risk advice, the insurance bit.
Okay.
Bit of an on.
Well, I mean, I suppose is that an underlying tone for self-managed super funds? Is understanding risk and either controlling it or preparing for it?
Yeah, absolutely. And there was actually some recent changes to the legislation that what the government's saying is that if you look at insurance inside self-managed super funds, about 13% of members have insurance.
Yes.
Whereas there's about 25% of members in large funds that have insurance through their super fund. And what the government's saying is, well, why is there a difference there? And there might be perfectly valid reasons for that.
It sort of feels like that's a low number
Yep.
for insurance.
It is. So there's a general level of underinsurance in Australia, and that's a real issue. And that probably comes about for two reasons: that we're generally a risk-taking culture down here. We love to gamble.
Yeah.
Gambling with our financial future is part
Yeah.
of that. And I think the other bit around it is that people have a lack of understanding of, or maybe they don't want to think about what has to happen in certain situations. And there's also just the simple cost of it, that some people will look at it, say that's too expensive, I can't afford it, I will take the risk.
All right, can I ask a really silly, seemingly silly question?
Mm-hmm.
What are you insuring for? I mean, what are the circumstances that I will need insurance for my self-managed super fund? If I put the money in the wrong spot and I lose it,
Yep.
can I have insurance for my own stupidity? Is that...
Okay, are we now talking about insuring for your liabilities outside the fund, or are we insuring inside the
Well, I
fund?
suppose that's the question, isn't it? Can I get insurance for both things?
Yeah, absolutely.
You're kidding.
So in terms of what are you insuring for outside, now I understand you've got young kids, I think.
Yeah.
Typically when people are young, they're single, they don't have a lot of liabilities, they don't have a lot of responsibility. If the income stops because they become deceased or they're injured, doesn't have, well, maybe if they're injured it's probably not such a good thing, but in terms of their death it doesn't have a major impact. But once you get into a relationship, you take on mortgages, you have kids, once that income stops and when someone passes away, that will have a major impact on the lifestyle of your wife and family.
Yeah, but I've got life insurance for that.
Yes.
And what you're talking about in risky business is
What
insurance within...
Yeah, so what I'm talking about within risky business is the issue around what happens with the fund when it's gone out and borrowed. So let's say you went out and borrowed to buy a house. I don't know whether you did or not, but if you did, then
you know I did.
Then what happens is, same thing with a self-managed super fund. The super fund is a different entity.
Yeah.
And that's what a lot of people kind of fail to get around. They think it's their money. It is, but it sits inside this trust structure.
Yeah.
And if there is, a death of a member, there's a likelihood that either an income stream needs to start coming out of that fund, or an amount of capital in the form of a death benefit payment. And if you've gone out and borrowed to buy an asset such as a business real property, a commercial property, or a residential property, then taking those assets out or that capital out means you've got less investments in there. So let's just say you haven't had to sell the property, but you've gone and sold all your shares to pay out the death benefit, then that fund is no longer generating income from those shares and may put it into a default position because no longer has it got enough money to pay the mortgage, right? So there's also potentially another issue there around just the simple liquidity requirements around the fund. So imagine you've got one fund that's got one major big asset and you've got two members in there. If one of them passes away, there's probably an amount of capital that comes out, and the only asset you've got sitting there is this business real property. And that means you're going to actually have to sell it out of the fund.
Yeah.
And you're a forced seller, which means you may be going into a buyer's market. Also, you think about the mental state of the surviving trustee, if that's a spouse.
Yep.
And you may be sold out by the bank or forced out yourself, which means that they can have a real impact. An asset that may have been worth $1 million, is you're accepting an offer for $850 or $800, and that can have a massive impact on the fund and their retirement.
So you can insure against that?
Yeah, so what you're doing is you're insuring, rather than to pay out a death benefit to your family, to look after their liabilities outside super, you're putting insurance inside the fund to protect the fund from potentially having to sell the asset. And that's, while I talk about family funds, that's important, but it's more important where different business partners come into the one fund for the purpose of gearing up to buy something like a commercial property that they're going to run a business on.
What's your sort of acceptance level of people taking on what you're talking about, or as the shutters go up
No.
when the insurance word is...
Well, I don't talk, in my role I don't talk to clients, but I'm talking to the advisors.
Because
right?
you're banned.
Yeah.
No clients for you, Tiger.
It gets complicated, right? But we are seeing a big pickup with the advisors paying attention in this space, because once we get to 1 July,
Yeah.
well, the advisors will have their client's best interest at heart, right? And so they don't want to gear them into a property which then can expose them to a lot of risk, and if there's a death or disability, you can really muck a client up. Right, so the advisors are interested just from a perspective of protecting their clients. Then also from 1 July we have the new FOFA announcements or rules coming through, and one of those is best interests.
Yep.
So an advisor is required to look at a client's circumstances and act in the best interest of the client given those circumstances. If you've just geared a client up or being involved in recommending a gearing strategy, you now have a best interest requirement to actually look at that fund and say, well, if something happens here, then this fund is going to be put into a high-risk position of having to be sold out and take a massive financial hit.
Yep.
I have now an obligation to actually at least talk about this strategy with the client.
Okay, technically, and that's your area of expertise, do you see it as an exciting area? Is it certainly a growth area?
Well, self-managed super funds in general is pretty, well, I find it exciting, but that's me. And it is, because you've got this growing area of limited recourse borrowing. It's been in for a couple of years by now, but it's really only beginning to really pick up a head of steam at the moment. And a lot of advisors are getting into this space, and they're excited about the gearing and the strategy potential. But then there's this other side of it that say, that's great, you've geared them up, fantastic, but you've got to think about this as well. And it's just part of the complete financial plan for the client.
Fantastic. Thanks, Craig.
No problems.
Craig Day?
No worries.
Colonial First State.